You're much too marvelous, marvelous for words like glorious, glamorous, that old standby. All right, have your attention. We're ready for the next session, which is going to look at the crypto market's encroachment and infiltration into public markets. So think crypto companies IPOing, SPACing, de-SPACing, of course, DATs, the Cambrian explosion that happened last year and then blew up spectacularly this year, I'm sure will also be unpacked. And we'll bring on Connor Emmons, head of institutions at Injective, to spearhead and serve as our vanguard of this conversation. I'll let you take it away, sir.
Thank you, Fred.
Good luck.
The tunes were nice.
Thank you.
Let's do this thing, guys. Alrighty, well, we are very excited to kick off the next segment here before lunch. We won't keep you too long, but I'm Cooper. As Frank noted, I'll be your moderator. And before hopping into things here, would love to give everybody the opportunity to introduce themselves. And Sochil, would love to start here down with you.
Sure. Hi, everyone. My name is Sochil Ivory. I work at Anchorage Digital. We are a federally chartered bank, crypto bank. We've been having that for 5 years. And I'm on the institutional team, institutional director, and oversee sales for VCs and investors.
I'm Stephen McClure, the CEO of Canary Capital. We are a hedge fund that also has a ETF business focusing on primarily altcoins that have some kind of tokenization feature.
I'm Joseph Shalom. I'm the CEO of Sharplink. Sharplink is a digital asset treasury company and the second largest owner publicly of ETH, the token that secures Ethereum. Before that, I spent 20 years at BlackRock, definitely the most traditional of people on this panel, where we launched the largest ETFs in history in the crypto space, as well as the largest tokenized funds in the space. Really happy to be here.
Awesome. Well, thanks for being here with us. But before jumping into products and financial products related to crypto, et cetera, I wanted to chat with you guys specifically about kind of, where we are in the state of the market and kind of what's going on. Obviously, we've seen massive drawdowns in altcoins and Bitcoin, et cetera, but where are we in the cycle? And for many of the folks listening here today, what is a cycle? From your guys' perspective, let's just open it up and would love to hear whoever wants to take it first.
Sure. I think if you're a short-term speculator or you're a trader, you feel really bad about the state of the crypto markets. But actually, if you're a futurist, an investor, an institution, now may be the most exciting time in crypto. Ethereum's been around for 11 years. Bitcoin's been around for 17 years. And the level of institutional adoption is like nothing we've ever seen before. And I think we're in the bottom of the first inning around stablecoin adoption, tokenized real-world assets. And I believe very strongly that if Clarity Act passes, DeFi will become the execution layer for most of finance, with agentic being the automation layer. So I think if you're focused on short-term price movement, it feels very cold. But if you actually look at the fundamentals of what's happening, not in crypto, but in finance, you should be extremely bullish. And I would argue that the risk-reward of entering the space right now has probably never been better than in the last several cycles.
Yeah, I would just add to that if you're not familiar with what a crypto cycle is, it's the concept of basically digital asset prices moving the same way any emerging assets has moved, right? So there's periods of expansion, of consolidation. Right now we're in a consolidation phase. But I agree with Joseph. I think there's a much bigger infrastructure upgrade happening beneath the markets that continues to happen regardless whether the price is up or down.
Yeah, I'm going to say this is my fourth cycle, and this is a drawdown for ants if you've been through other ones. And even the high of last year was a lot less than a blow off top, which is what everybody was expecting. There were a lot of people that believed that the 4-year cycle was dead, it's over. I believe it's still in place, at least for a few more years. The reason why we have these 4-year cycles is Bitcoin is the largest asset and every 4 years there's a halving that happens, and it really has to do with miners. So miners collect money by processing transactions, processing data, and when the halving rewards are cut in half, they have to spend more of their Bitcoin in order to pay for things like software, hardware, and utility prices. One of the reasons why the cycle looked like it was off last year from a percent increase standpoint was a lot of things happened last year that forced miners to begin to sell early. A lot of them were getting ahead of the current cycle that we're in right now, and energy prices went up pretty substantially. So that earlier increase in energy prices while they were beginning to sell out of their Bitcoin to pay for things, caused the cycle to be off a little bit, but it's still, the 4-year cycle is still intact. And right now we are, in my opinion, at the bottom of the current cycle. There is a chance that Bitcoin could go back down into the 50s for a brief period of time. But the consolidation has happened. We're moving forward now at a pretty great rate. And the really interesting thing about this coming cycle that I believe is going to be a little bit different than previous cycles is the increase in tokenization of RWAs. And I believe that a lot of the tokens that represent chains that are strongest in tokenization are going to be the ones that come out ahead in this current cycle. So that's where we're focused on.
That's awesome. That leads directly into the next question, which is why do you guys think this technology, price action aside, has the ability to reinvent capital markets? And Joseph, I know you've spoken on that quite a bit. Stephen just kicked things off there and teed it up quite nicely. What's your take on that?
I think it's just an upgrade of an archaic financial system, and you can just think of it as akin to digitization of a process. I worked at the world's largest asset manager. I had a front row seat on how inefficient it is. The idea that if you trade an asset, you don't receive the asset for a day. And if you trade it on a Friday, you don't actually receive it till a Monday. And if your country goes to war on a Friday night and the markets are closed and you want to express your views on your portfolio, you can't do that. And so the idea that 24/7 with instant settlement, credibly neutral, and I'll translate that into TradFi, no counterparty risk, no settlement risk, credibly neutral, decentralized, are words that actually have meaning outside the crypto space. And then the final thing that I think we're largely underestimating is this idea that retail investors right now hold a stock or a bond or a fund, and they do very little to make it productive. You hold cash, it's idle, there's not much you can do with it. When the world of stable coins plus tokenized assets plus decentralized finance happens, anyone can own a tokenized version of anything. It will be composable, which means you can borrow against it, you can lend it, you can use it for leverage, and that will allow retail investors to almost have a CFO in their pockets. If you're at BlackRock or a large institution, they have people who wake up every day trying to make sure no idle cash. If I own a stock, I'm lending it. If I have some other fund, I might use it as collateral. These are things that are going to be part of daily lives, and I don't think you're going to realize you're on the blockchain. We're going to completely abstract the user experience, and no different than using your phone or apps, you don't think of what sits under it. So you can think of crypto being the iOS of the future of finance, and I think it's going to create tremendous prosperity, not just more transactions.
Awesome stuff. Social, any thoughts, or Stephen, any thoughts just in terms of technology, where we're going with it, et cetera?
Yeah, maybe just to give a concrete capital market efficiency example to add to what Joseph said. So we recently at Anchorage launched something called cashless reserves. We launched this with JP Morgan and Solana. And effectively what that model replaces is the traditional model where stablecoin issuers hold on to 10 to 15% of the reserves in order to service redemptions. So this model essentially, what it does, it makes sure that the reserves that you have are now sitting in yield-generating, low-risk tokenized instruments, and it can be made cash on demand. So that's a real example of how this efficiency is happening today.
Yeah, I mean, I got into blockchain full time about 10 years ago, and the primary reason was I was a former bond manager, bond trader, and I focused, if you're trading benchmark bonds, your settlement date was anywhere between 1 and 3 days at that time. It's gotten a lot more efficient. But if it's non-benchmark, which is over 50% of the rest of the bond market, your settlement time could be anywhere from 3 to 30 days. So think about that for a moment. If you're trading, esoteric fixed income, bank loans, high-yield bonds, or structured securities, then you might have to wait 30 days for that settlement to happen. Now, that wasn't always the case, but that was the outlier case. Commonly, 10 days was the settlement period. And I saw an opportunity for utilizing blockchain to make the bond market more efficient, and that's really all I thought about, and I ran emerging markets as well, and and if you really dig into markets around the world, there's people that come here to work, to go to other places to work. They have to send their money back home, and oftentimes, so let's say that you're living in a country that's not the U.S. or the U.K. You actually have to trade that currency for pound sterling or U.S. dollars, and then trade it back into your home currency. And that's two different layers of fees that people are paying for their hard work, for their hard-earned money. So those two things combined, I think were the main reasons why I got into this. And 10 years ago, a lot of us were doing tokenization, and it just failed because there was no market for it. We were building all this technology, we were building processes, talking to the SEC, talking to Congress. And it was great. We got a lot of things built. And now, is there a market? I'm going to argue that there is going to be a market. There already is a market for stablecoins, which is extremely important. And that market is quickly expanding into other real-world assets and other types of securities that aren't as efficient in the market as, say, ETFs and equities.
That was a great, kind of answer there. To follow up just specifically on the stablecoin piece, can you kind of jump into that? That was something that I wanted to touch on later, but let's just talk about it now. The purpose of stablecoins, what is that market? Why is it important? And who are the users? And, who are the big beneficiaries? I think it's very, an interesting concept given that we're in DC and, a lot of these stablecoin issuers hold a lot of paper.
Yeah. Well, there's a lot of people around the world that have been using stablecoins for a very long time. It's a much more efficient way to send money, right? So let's imagine for a moment that you're a video game developer, okay? And you've got studios around the world, and then they outsource to developers around the world. So you might have a studio in Australia, and then they're outsourcing to Romania, and just the simple method of paying people is a pretty big task. So stablecoins allow that payment to occur instantaneously. For years, you've been able to pay somebody within seconds with a stablecoin that they can then use to buy things or to pay other people. And as that particular area of the market begins to progress, not just in U.S. dollar stablecoins, but in stablecoins for other currencies, and then creating trading pairs for those various currency stablecoins, it gives billions of people access to markets when they can't even access a bank. And that is really where this is all going. The importance of the U.S., understanding that, look, there's a lot of people around the world that want to have dollar stable coins because they are stable. U.S. dollar is the most powerful currency on the planet right now. And to have these stable coins that are essentially buying U.S. debt to back it, which is pretty brilliant. But buying U.S. debt that helps us as a country, but it also helps the stablecoin providers as well create a stable backing for the currency that people are trading.
Yeah, that was a great answer. All right, let's jump into another topic, which you guys are the experts on. Let's jump into regulated financial products holding these types of digital assets. So, I mean, just to get started, Joseph, would love to kick this first question over to you. Would love to get into all the intricacies of DATs, but I realize, we have a lot of folks here in DC. What are DATs? How did we get DATs? And kind of, what is the purpose and the mission of them moving forward?
Sure. DAT is an acronym for Digital Asset Treasury, and the first digital asset treasury was Michael Saylor, who believed that there were a lot of investors who wanted to own Bitcoin, but they only had two ways to own it. They can open a crypto wallet, onboard, try to get cash in there, and then try to understand how to custody and take risk of owning Bitcoin. It's called owning the spot token. Digital asset treasuries were essentially an invention where they're a public company. You can go on New York Stock Exchange or NASDAQ. If you want access to Bitcoin initially, you just buy the stock and you get access to it. You don't have to worry about custody and the like. Last summer, there was almost a summer of digital asset treasuries. I lead the first and now second largest digital asset treasury on a token called Ether. It's the token on the Ethereum blockchain, which basically transacts over 50% of stablecoins, tokenized assets, and DeFi activity. But Ethereum is a slightly different animal than Bitcoin. Bitcoin is not productive. I've launched the largest Bitcoin fund in history, but you hold it as a store of value. It's like digital gold. You hold it because you believe your government is going to debase your currency. It's like a hedge. Ethereum is programmable, and Ethereum has staking yield, where if you own ETH, you can put it back to secure transactions, and you get about a 2.75% yield. So the idea was, if you want access to this long-term Ethereum opportunity, you want to own Ether, you can kind of try to go buy spot Ether, deal with the custody, try to learn how to stake it and get the yield yourself, or you can buy an ETF, and when we launched, ETFs could not stake, so you were missing the yield. Or you could just buy a public equity. And last summer when we launched, we raised about $3 billion from investors who wanted access to this vehicle because they believed in the long-term Ethereum opportunity. And then there were digital asset treasuries on Solana and a long tail of crypto tokens. So you can think of it as
also
an exposure
INJ.
vehicle. That's right, on Injective, because each of these chains and tokens has a thesis on how they're going to help transform finance, and owning the tokens via public equity is just very efficient if you have a strong management team.
Totally. So jumping over to social, you chat with institutions every day. Kind of what's the common theme across what you're seeing in terms of institutional investors, and what are they looking for from a custody trading services perspective that is relevant to a lot of the folks here from legislative perspective?
Yeah, maybe even narrowing it down a little bit more, how the question has changed from, I think, the introduction of DATs and ETFs right now. So the most common question that I get, that we come across, is who's holding the assets and under what regulatory framework? And that question hasn't really changed. It's more that it's gotten more sophisticated over time. But it's very different from 2 years ago when I was, just like you, on the institutional side at Blockchain Network, when the question was more, well, are we allowed to participate and what happens with this? Now, institutions have gotten very comfortable with regulated custody, federal oversight frameworks. And so now the question effectively has changed from, are we allowed to participate, to how fast can we move? And that's a really exciting change, I think, that ETFs and DATs brought. And also to credit the work that Steve and Joseph are doing, ETFs and DATs brought in effectively this whole entire new universe of institutional buyers that wanted exposure to the asset, but really weren't able to hold it directly. They needed a familiar wrapper to do so.
Totally. Well, to that point, Stephen, let's jump over now to ETFs. Obviously, we know about the big Bitcoin ETF that's driven a ton of flows. What does that look like in terms of evolving? Also, outside of that, what do we expect in terms of new ETFs? Hopefully, an INJ ETF, but Stephen will be the expert there as he leads Canary Capital. Kind of give us what that looks like.
Yeah, so I've been involved. I got involved in ETFs accidentally, several years ago, And then when it looked like things were going to change as far as regulation goes in the U.S., we had, my previous company had filed for a Bitcoin ETF, which launched. But while we were waiting, we focused on some of the ones that were in and around Bitcoin. We actually launched the first DAT ETF. We called it Bitcoin on the balance sheet. And at the time, there was only like Tesla and MicroStrategy that qualified, and then a few others that held Bitcoin that were publicly traded companies in various ways. We also launched the first Bitcoin mining and Bitcoin futures ETF on Nasdaq, and those were really interesting products. It gave investors the access that they were looking for ahead of when the whole slew of ETFs were approved several years ago. Now we're focused on, as I mentioned, ETFs of tokens that have usefulness and things like RWA tokenization. So we've launched 5. We just started the company a couple of years ago. We've launched 5 ETFs in the last year, and we probably have another 3 or 4 this year. Hopefully, Injective is one of them. You still have to go through the process.
Fingers crossed.
Yeah. Hopefully, you still have to go through the process with the SEC, right? You file an S1, you get comments, you go back and forth. There's other requirements that came along about a year ago through generic listing standards after Bitcoin and ETH were launched as ETFs. So once that got passed, it became easier to launch token-related ETFs. So I believe that there's going to be a good amount that will do well. There's probably going to be about a dozen, 2 dozen that are really strong, and again, mostly tokens that are doing real work in tokenization.
So to all those products, as a follow-up to that, who are the marginal buyers? And Social, I'd love to hear your thought from a trading perspective, et cetera, but then also coming down the line here, who are the marginal buyers if you can just go and buy this stuff on Coinbase or Kraken of these types of wrapped financial products?
Yeah, from where I sit, or as a custodian, what we see is it's asset managers, it's banks, and increasingly it's also corporate treasuries, and not necessarily because they just woke up and discovered crypto, but because now they're more familiar with the wrappers, the regulatory wrappers that are being used.
Yeah, when we first launched each of the ETFs that we launched, the first buyers were retail, and a lot of retail investors, sure, they can open an account on an exchange, but it's a lot easier to hold it in your brokerage accounts and trade it in your brokerage accounts and manage it there, right? So there's a lot more protections there for them as an investor. Not everybody is sophisticated enough to create your own hard wallet and learn how to trade. Certainly, when I first got into Bitcoin many years ago, it was a nearly impossible task. Unless you were a high-level programmer, you're going to lose your money. A lot of people didn't, but some people did. But as we've progressed and as this has become a lot more commonplace, we're talking to a lot, financial advisors are deep into buying crypto ETFs, as are insurance companies, pension funds, and even sovereign wealth funds. Sovereign wealth funds, I think, are going to be the next big iteration in inflows. Insurance companies are going to be a little bit further behind because of the way that their capital treatment works. So you have to hold about 30% in cash to hold a crypto ETF or crypto in general, just like you do with a private equity fund or venture capital fund. So it's a lot less efficient for them unless you can create an instrument that they can actually use, like a structured product. So insurance companies are probably going to be very last in adoption, but sovereign wealth funds are the ones that are the biggest buyer right now.
Yeah, I'd love to hear your thoughts. I know you guys are in the public markets. Congratulations on another large fundraise. More recently, how does it working in the public markets or capital markets specific to what you're doing at Sharplink?
I think last summer when you had the summer of digital asset treasury launches, there were like 50 Bitcoin treasuries, 6 or 7 Ethereum, a number on Solana. It was largely a fast retail momentum trade. You had a lot of Asian retail investors in Korea, Hong Kong, Singapore, Tokyo buying. It's transformed nearly 100%. When I started Sharplink as a digital asset treasury, we were 6% institutionally owned, 94% retail. Today, it's over 50% of my investors are large institutions, funds. Fidelity's our largest investor. As you said, they can't necessarily hold and custody spot ETH, so they get exposure through us. And even insurance companies, they view us as a public equity, and they just have tax treatment and RWA treatment as a public equity. I think the biggest challenge, you started with the question of price of crypto. I think you didn't ask this question, but I'm going to answer it. The biggest challenge in crypto today is we don't have the next retail incremental buyer. Much of the retail buyers of crypto have now moved to buy Samsung and SK Hynix and NVIDIA and SpaceX, another risk-on asset that they see having an ability to go up 5x, 10x. And until that cycle breaks that you were talking about, and we're able to attract not just institutions, but the next retail buyer, I think it's going to be a bit of a consolidation period and a challenging period. But these things rotate, they move in cycles, and I'm quite confident that, again, the risk reward of entering now is pretty strong.
Yeah, no, great answer across the board. Well, while we are here outside of Capitol Hill to discuss policy and how that's relating to everything that you guys are working on. So, Stephen, I want to start with you. Give us your take on Clarity Act and how that's specific. I know you might have an interesting take based off of the dinner I had last night, but what's your take on Clarity and how that's beneficial for this entire industry and in specific the products we're discussing?
Well, the first thing I should mention is that whether Clarity passes or not, it has zero impact on my business. We've been running this business and in previous iterations other businesses that we just simply follow securities laws. It does have an impact on other people's businesses, so I don't want to belittle that. But I think most of Clarity is actually good for the entire industry. There's a couple of areas of Clarity that I don't really think should be in there. And this is where it gets controversial and people argue with me. But for instance, the piece that says that stablecoins should be able to distribute a yield, I don't think that should be part of Clarity. I think that falls under the 1940 Act. It's very easy to simply put a 1940 Act wrapper around these products and make them securities. And they can still be traded by retail investors. One of the reasons why I don't believe that you should be able to distribute a yield on these stablecoins unless they're securities, because they're buying and selling and holding, for the most part, U.S. treasuries and other bonds. And that activity alone, and you distribute that yield, that makes you a mutual fund. So you should fall underneath mutual funds if you want to make the distribution. If you don't want to make the distribution, fine. Tether makes a lot of money by not making a distribution, and they probably want to continue to do that, as does USDC. So, but to force an act that does that, well, what comes next? Okay, well, all the asset managers, which I formerly ran mutual funds, are going to raise their hands like, well, what about us? Where's our exception? We don't want to have to, we don't want to have to fall within the 40 Act to be able to distribute the yield that we're earning within our vehicle. So that's the biggest piece that has the most amount of argument right now between crypto and the banks. And even though I'm in this industry, I think the banks are right.
Yeah, so I guess interesting take, and we can jump around, but beyond any single bill, kind of what would you guys see as the most kind of important things for lawmakers or regulators to understand in terms of accelerating innovation? And Social, would love to start with you and then bring it over to Joseph. I know Anchorage has been federally regulated for over 5 years now. What does that mean in the context of your day-to-day business? How has that been helpful based off some of the things we've heard on the panels today? And would love to kind of give you the floor there.
Yeah, maybe I'm not a I will preface, I'm not a regulator myself, of course, so I will keep it a little bit broader, but for the implications on the operator side. For example, federal supervision for stablecoins, I'll just make it very practical, what that entails, right, for how we've been operating in the business. That in itself basically means that it's a fancy way of saying that stablecoins now have to adhere to all the guidelines and this full suite of services that any national bank has to adhere to, right? So think capital and liquidity requirements, AML compliance, all of the exams, audits, all of that. For the stablecoins that we issue at Anchorage, all of those, the federal oversight there applies through everything, right? So throughout the entire flow, how reserves are being held and managed, how redemptions are being done, the full operational stack, essentially. There's federal oversight every step of the way. And what that does for institutions in turn, it makes their lives so much easier, right? They now recognize the frameworks that they're working with because it's similar or the same as the one that they're operating in. So I think federal oversight, long story long, is very positive for institutional adoption because it gives the serious players something to build against.
And it's very impressive as well. But Joseph, would love to kick the question over to you. Hear your take from a public market perspective.
Well, we're a public company, so we comply with all U.S. public company rules. I think there is a micro impact and a macro impact if clarity doesn't pass or the regulators don't rule make what we need to have done. One is just sentiment will be really bad, and whatever cycle you believe in or don't believe in will get extended. And I think that's bad for the industry. I don't think it'll really slow down tokenization and stablecoin growth materially, but the sentiment will be bad. The macro impact is, I have not been to Europe in a year. I've been to Asia 5 times in the last year. And if you go to Seoul, Tokyo, Singapore, Hong Kong, and Taipei, they're watching what's happening over here really, really closely. And the crypto industry, the fintech industry will literally copy the moment that Clarity Act happens. If Clarity Act doesn't happen, they're going to move just as fast to seize the momentum. And we're going to be back in the days where you have development and stable coins moving offshore. And I fear that America will lose some of its competitiveness. And you can't stop technology innovation. This will slow technology innovation in the United States. I believe very strongly that the Genius Act was passed first for exactly the reason you mentioned. You know, Tether and Circle, the 2 largest issuers of stablecoins in the world, are the 12th largest creditor of the US government. So at a moment when Russia, China, Europe is slowing down purchases of US treasuries, like having more buyers of treasuries is an amazing thing. And so I believe the geopolitical impact will be bigger than any other impact we're talking about today.
I totally agree, and I think that's something that people don't necessarily focus on as much. Well, all right, I'm out of questions. You guys have been fantastic. I'd love to allow you guys each a couple minutes in the room with regulators to kind of give the perspective pitch of, you come for 3 of the largest and, most credible institutions from, the crypto side of things. Sochil, would love to start with you and kind of, have you take the floor in terms of giving the room kind of, what they should be considering in terms of rulemaking and the future of innovation for this asset class.
I'll keep it to custody in that sense. I think people in the room often think about Anchorage as a vault, and we're not, right? We're essentially a piece that makes participation possible in the space. We enable participation, whether it's staking, governance, stablecoin issuance, you name it. So people view oftentimes, or a misconception that people have, is that custody is passive. And really, the role that we do have is making it possible that every single product in this room can exist today, right? There is no ETF, no stablecoin, no treasury strategy that exists without trusted infrastructure underneath. And so we're not the most exciting part of the story, maybe. I think so, I'm maybe biased. But we are the part that makes the story real. So consider custody as enablement, not as a vault.
Yeah, I actually think that the most important thing that happened was the selection of Chairman Atkins to the SEC. and it's really transformed the SEC into. I mean, the staff itself, they've always been very keen to work with us, over the last many years, but this does allow a little bit more progress from the SEC standpoint. For instance, there was no reason why Bitcoin as an ETF should not have been able to be launched back in 2017. So the SEC is taking a different type of stance here. And it's not laissez-faire either, which is actually a concept I believe in, but you still have to work through the process, right? It still takes months of comments on S1s to be able to launch an ETF, and that's really where I'm focused on right now. But it is still a long process, but it's a good process. Making sure that proper disclosures are there, making sure that proper processes are in place from an asset management standpoint to make sure that you're not going to lose money. But I think that's the most important piece right there is the regulators.
Look, in my previous work at BlackRock, we spent most of 23 talking to the Biden administration and Gensler about their priorities. And I think if you're a leader, you need to understand the priorities of the people you're sitting across. And a regulator and a legislator in this space should have three priorities: protecting the market structure and participants, protecting investors, investor protection, and creating the sandbox for innovation. And when we were speaking to the SEC, asking for permission to launch the first Bitcoin ETF in the US, we didn't try to fight them. We explained to them that this is good for market structure. It's actually going into the hands of regulatory fiduciaries who are going to manage these. It's much better for investors to have custody and asset management through a BlackRock, a Fidelity, a Franklin Templeton, than it is for them to go offshore to an offshore unregulated exchange and buy Bitcoin. And in the case of Clarity Act, I would argue that please don't let perfect be the enemy of the good. This is going to be great for investors. It's going to be great for financial innovation. It is going to rewrite market structure. And we know technology progress cannot be stopped. We are going to rewrite the rails of all of financial infrastructure, help us do it, and give us those guardrails so investors, market protection, and innovation can be put first. But it comes down to understanding what their role is and then explaining to them that this is good for their three priorities as well. That would be my take. And I have a lot of scars from doing that, from a very hostile administration to crypto. But ultimately, I think education is how you do it, not suing or fighting your regulators.
Well, incredible stuff and very well put by these three panelists. I don't want to hold anybody up here any longer. Again, thank you all, and let's head out. And Frank, I'll hand things back to you. I think you might know what's next.
Cooper, that was amazing. You did a phenomenal job.
Thank you to Injective. Thank you, Cooper.
Thank you. Appreciate it.